feeling like the world of options is this massive maze, especially if you're gearing up for CFA Level 2.
Oh, yeah.
You're definitely not alone.
Yeah.
It can seem overwhelming, but today we're going to map out one of the key pathways, the binomial option valuation model.
Exactly. Think of this deep dive as your personal shortcut to understanding this really foundational model.
Okay.
We're going to unpack how it helps us put a price on options, particularly by focusing on the idea that, in a well-functioning market, you can't make something out of nothing.
Right.
That's the essence of no arbitrage.
No arbitrage. Right. So our goal today is to really demystify the binomial model for you. We'll start simple, looking at a single step in time, and then build up to 2 steps.
Yeah.
We'll also see how this model handles different kinds of options, whether they can only be exercised at the end or maybe earlier.
Yeah, American versus European.
Exactly. And even how it can be applied to something like interest rates, which is interesting.
And at its core, the binomial model takes a seemingly complex future-like, where a stock price could go, and simplifies it right down. Just 2 possibilities over a set period, up or down.
That sounds manageable,
Yeah.
right? Just up or down. But from that basic idea,
Yeah.
we can build a surprisingly robust framework.
Totally.
We'll be talking about how we visualize these possibilities, these sort of pathways. They call them nodes and arcs.
Yeah, nodes are the points in time and price, arcs are the paths between them, and we use what we call the up factor and down factor, basically the multipliers for those price movements.
Okay, the U and DA factors.
Right. And a really insightful concept that comes out of this is the idea of a replicating portfolio.
Ah, yes, replication.
This is like creating a mirror image of an options payoff by strategically combining the underlying asset with either borrowing or lending.
Okay, let's really dig into this replicating portfolio.
Yeah.
It's like we're trying to build a synthetic version of the option using the actual stock and some financing. But why? Why go to all that trouble?
Well, it all boils down to 2 fundamental principles for anyone trying to find risk-free profits, arbitrageurs.
Yeah.
First, you shouldn't have to use your own money. 0 initial investment. Second, you shouldn't be exposed to any price risk. Your outcome should be certain.
No risk, no capital. Sounds good.
Exactly. So if you can construct a portfolio that perfectly mimics an options outcome, no matter if the price goes up or down, and it costs less than the option is selling for, or generates more cash up front, well, you've found an arbitrage opportunity.
The free lunch, which, as we know, isn't supposed to last long in efficient markets.
Mm-hmm.
So how do we track this? You mentioned cash flow tables.
Yeah, cash flow tables are simply a way to organize the money coming in and going out. Think of it from the arbitrager's perspective.
Okay.
Negative numbers are cash outflows, buying stock, lending money. Positive numbers are inflows, selling short, borrowing, receiving option premiums. By looking at the net cash flow at the start and end, we see if there's a risk-free profit.
Got it. So it just lays it all out clearly.
Yeah.
All right, let's take a concrete step and look at the simplest scenario. The one-period binomial model.
Okay.
Imagine a stock price today, S. Over one period, it can either jump up to S plus or drop down to S. Just those 2 outcomes.
Exactly. Now, if we have, say, a call option on this stock, its value at the end of that period is easy to figure out, right? It depends on whether S plus or S is above the strike price.
Correct. Max 0 S plus X or max 0 SX.
Perfect. The crucial part is figuring out how much of the underlying stock we need to buy or sell today. Let's call that amount H, or the hedge ratio, along with some borrowing or lending, so that the payoff of our little portfolio is exactly the same as the call options payoff, whether the stock goes up or down.
This sounds like where that hedge ratio
Okay.
aging comes in. It's the magic ingredient.
It kind of is, yeah. The hedge ratio tells you the exact number of shares of the underlying you need to hold for each option you've written, or vice versa, to make your combined position insensitive to small changes in the stock price over that period.
So it balances things out. How do we find it? Is it complex?
It's actually quite intuitive when you see it. It's basically the difference in the option's possible payoffs, the high payoff minus the low payoff, divided by the difference in the stock's possible prices, the high price minus the low price.
Ah, okay. The change in option value over the change in stock value. Makes sense.
Precisely. It creates a neutral position for that one step.
So once we've figured out that perfect hedge ratio, we can then determine the no arbitrage price of the call option today, right?
Exactly. The value of the call option today, you see, must equal the cost of setting up that replicating portfolio. So it's the cost of buying H shares of the stock minus the amount you need to borrow. Or you can think of it as buying H shares and adding the present value of the certain payoff you'll receive at the end.
Okay, so the cost of the stock part plus the present value of the financing part.
That's a perfect way to think about it. And this shows something fundamental. Holding a call option is economically kind of like having a leveraged stake in the underlying stock. You get the upside exposure, but funded partly by borrowing.
And what's really neat here is that the model doesn't get bogged down in trying to figure out some complicated risk-adjusted discount rate.
Yeah.
It just uses the risk-free rate. Why is that okay?
Because we built a risk-free portfolio. By hedging perfectly, we've eliminated the uncertainty about the payoff. Since the payoff is certain, the only appropriate rate to discount it back is the rate you'd get on a certain risk-free investment.
Ah, the replication itself removes the need for a risk premium in the discounting. Clever.
It is.
We focused on calls. What about puts? Can we replicate those too?
Absolutely. Same logic applies. A put option can also be replicated using a combination of the underlying asset and financing. But for a put, since its value goes up when the stock price goes down, the hedge ratio H is typically negative.
Negative, meaning?
Meaning you'd typically short H shares of the stock and combine that with some lending investing at the risk-free rate to replicate the put's payoff.
Okay, shorting the stock and lending makes sense as the payoff is flipped compared to a call. Now, you also mentioned put-call parity earlier. Sounds important.
It is. Put-call parity is really a cornerstone. It's a relationship that has to hold true based purely on no arbitrage, regardless of how you think options are priced, binomial, Black-Scholes, whatever.
Model independent.
Exactly. It links the price of a European call, a European put with the same strike and expiry, the underlying stock price, and the present value of the strike price, all together in one equation. If you know any three, you can instantly find the fourth. Very handy.
Definitely a useful shortcut.
Mm-hmm.
So that's a single-step view. But, the world doesn't usually happen in just one step. That brings us to the two-period model.
Right. The two-period model just extends the same logic. We apply the up or down possibility over two consecutive time steps.
So now we have more potential outcomes at the end, right?
Yep. Instead of just S plus and S, at the end of two periods, you could end up at S plus plus up twice, S down twice, or S plus up then down, or down then up.
And you mentioned something about a recombining lattice. What's that about?
Ah, yes. A recombining lattice or recombining tree just means that an up move followed by a down move, S plus Macus, results in the exact same stock price as a down move followed by an up move, S plus.
Okay, so the order doesn't matter for the final price in the middle.
Correct. And this is a huge computational advantage. It stops the tree from becoming exponentially bushy as you add more time periods, keeps the number of nodes manageable.
Yeah, I could see how that would help. Keeps the tree from exploding. So how do we actually value the option in this two-period world? Is it just repeating the one-period thing?
Pretty much. But you work backward. You start at the very end, time 2. The options value at each final node, S plus plus S plus S plus S plus S, is just its exercise value, max over S SX for calls, max 0 XS for puts.
Okay, payoffs at the end.
Then you step back to time 1. At each node in time 1, you know the two possible option values at time 2 that could follow. Using the same one-period replication or no arbitrage logic, you calculate the options value at that time 1 node.
So you use the time 2 values to find the time 1 values.
Exactly. Then you repeat the process one more time, using the calculated time 1 values to find the options value back at time 0 today. You're essentially rolling the no arbitrage condition backward through the tree.
It's like solving a maze backward, like you said.
Yeah.
Start at the end and work your way back. Now, there's another way to look at this, involving risk-neutral probabilities.
Yes, the expectations approach. Instead of explicitly building the replicating portfolio at each step, we can calculate these things called risk-neutral probabilities. Let's call the probability of an up move pi.
Okay, pi. Is this the real probability?
No, and that's the key thing. It's not the actual objective probability of the stock going up. It's a synthetic probability. It's the probability that would exist in a hypothetical world where all investors are risk-neutral.
Risk-neutral, meaning they don't care about risk, they only care about expected return.
Precisely. And in such a world, all assets would be expected to earn just the risk-free rate. We calculate in a way that ensures this condition holds within the model. It depends on the risk-free rate and the up and down factors, U and D.
Okay, so it's a mathematical construct that lets us use the risk-free rate for discounting.
Exactly. Once you have pay and the probability of a down move is just 1, you can calculate the expected value of the option at time 2 by weighting the possible payoffs, C plus C plus SMANCI C, by their risk-neutral probabilities.
So it's like pay for the up payoff 1, 2 for down, down, and 2, 1 for the middle one.
You got it. Then you just take that total expected payoff at time 2 and discount it back 2 periods using the risk-free rate to get the option value today.
And this gives the same answer as the replication method.
Identical. They are mathematically equivalent ways of enforcing the no arbitrage condition, just different perspectives.
Okay, that's useful. 2 ways to get the same price. Now, we've mostly assumed European options exercise only at expiry. What about American options? That early exercise possibility must change things.
It does. This is where the backward induction method really shines. For American options, at each node in the tree, working backward from time 2 to time 1, then time 1 to time 0, you perform an extra check.
An extra check?
Yeah. You first calculate the option's value based on holding it the value derived from the expected future payoffs, just like we did for the European option. Let's call this the continuation value.
Okay, the value if you don't exercise yet.
Right. Then you compare that continuation value to the value you get if you exercise the option immediately at that specific node, the intrinsic value like SX or XS.
Oh, so you compare holding versus exercising right then and there.
Exactly. The value of the American option at that node is the higher of those two values, the continuation value or the immediate exercise value. You always choose the optimal action.
So at each point, the model is asking, is it better to hold on or cash it in now? And that difference, if the exercise value is higher, that's the early exercise premium being captured.
That's a great way to put it. It explicitly incorporates the value of the early exercise feature.
You mentioned earlier, though, that for call options on stocks that don't pay dividends, early exercise usually isn't optimal. Why is that?
Generally, yes. Think about it. A call option gives you the right to buy the stock. By exercising early, you pay the strike price now and get the stock. But you lose the remaining time value, the potential for the stock to go even higher, and the insurance against it falling below the strike.
Plus, you're paying the strike price sooner, losing the interest you could have earned on that cash.
Exactly. So unless there's a compelling reason, like capturing a large dividend payment right before it's paid.
Dividends. How do they fit into this? Briefly.
Dividends complicate it slightly. The typical approach is to adjust the stock price tree. You basically model the stock price X dividend. So when a dividend is paid, the stock price path drops by the dividend amount, or its present value.
Okay, so you build a tree using the stock price minus the value of future dividends.
Essentially, yes. It often involves thinking of the stock as two parts. A riskless part representing the dividends, and a risky part representing the ex-dividend stock price. And generally, paying dividends tends to make call options less valuable because the holder doesn't receive the dividend and put options slightly more valuable.
Right, makes sense. Okay, last area mentioned was using binomial trees for interest rate options. How does that work? The underlying isn't a stock price anymore.
It's an adaptation, yeah. The underlying here is usually a short-term interest rate, like a spot rate or a forward rate. The tree shows how this rate might evolve over time, moving up or down.
So the nodes represent possible interest rate levels.
Correct. A common simplification, especially in introductory models, is to assume the risk-neutral probability of an up move in the interest rate is 50%. It were 0.5.
Okay, 50-50 chance of rates going up or down in this risk-neutral world.
Right. Then, valuation still uses that backward induction expectations approach. You figure out the option payoff, like on a caplet or floorlet, at the final nodes based on the interest rates there. Then you calculate the expected payoff at earlier nodes using the 50-50 probabilities.
And you discount back. But the discount rate itself is changing in the tree, right?
Exactly. That's the key difference. When you discount the expected payoff back one period, the discount factor you use depends on the interest rate at that specific node in the tree. So the present value factor can be different for the up path versus the down path leading into that node.
So the discounting reflects the modeled interest rate environment. Got it.
It's a bit more involved, but the core logic of backward induction and risk-neutral expectation still applies.
Okay, wow, we've covered a lot of ground there, from the basics to American options and even interest rates. If you're studying this, what are the absolute critical takeaways from the binomial model?
I think the biggest thing is understanding why it works. It's a heuristic tool, yes, but it powerfully illustrates the fundamental principle of no arbitrage in option pricing. Options are priced to prevent free lunches.
Right. No riskless profit. That's the anchor.
Definitely. And remember the two ways to see this. The replication approach, building the option synthetically, and the expectations approach, using risk-neutral probabilities and discounting at the risk-free rate.
And crucially, that both methods get you to the same place.
Always. They're logically consistent, just different angles on the same problem. Understanding this binomial framework, even though it's discrete and simplified, really gives you the intuition needed for more complex continuous time models like Black-Scholes-Merton.
It really lays the foundation. Sure. To quickly recap, we've walked through the core logic, the up-down moves, replication, the one-period and two-period models, how American options add that early exercise check, the impact of dividends, and even how it applies to interest rates, all tied together by no arbitrage.
Exactly. It's about building that intuition that option prices aren't arbitrary. They're constrained by the possibility of constructing risk-free hedges.
So here's something to chew on as you review this. Think about that replicating portfolio. It's not static, right? In a multi-period model, that hedge ratio usually changes at each node. How does that constant need to rebalance the hedge reflect the day-to-day reality and the dynamic risk management involved in actual options trading?
That's a great point. The model requires dynamic hedging to maintain risk neutrality. It really highlights the active management needed. And while the binomial model simplifies reality, prices don't just jump discretely. The core concepts of replication and risk-neutral valuation are incredibly powerful and carry over to more advanced finance.
Absolutely. It provides invaluable intuition. Well, thanks for diving deep with us on the binomial model today.